firstly, to answer this, do they control the yield? It depends on what yield we're talking about, and it also depends on what we mean by control. So, do central banks control the yield? Well, there is some very specific examples where central banks will have very specific tools that aims to do exactly that by basically controlling where they allow these yields to go. So, a good example of that would be something like in Japan with yield curve control. If you take a look at this chart over here, which is the 10-year JGB or Japanese government bond yield, you can see that we've got two lines marked up here, a negative 25 and a plus 25 basis point line. So this is the 50 basis point band that the BOJ allows the 10-year JGB to fluctuate in and around. When it goes below that, they want to intervene. When it goes above that, they want to intervene. So they keep it capped between these two levels. So that is one way that a central bank can actually control the level, is by doing something like yield curve control. Now, in a normal environment where we don't have things like yield curve control, the central bank doesn't really control the yields because the yields are market-based, meaning that they will be driven by whatever the market thinks they should be based. Obviously, you know that bond prices and yields are inversely. They move inversely. So if the bond price falls, your yields will rise. If the bond price rises, your yields will fall. But apart from yield curve control, yields move independently to what central banks do because they are market-based instruments. But you will often hear us say that a central bank controls the short end of the curve. So what do we mean by that? If we take a look at this quick yield curve chart, let me just grab that on the screen for us. This is just a basic example of the US yield curve. The current one is in blue. The one from January is in yellow. Now, what we say when we say the Fed controls the short end of the curve, this part over here, is that whatever the Fed sets the short-term interest rate at, so if it's the Fed funds rate, or let's say it's the Bank of England's bank rate, or the RBA's cash rate, or the RBNZ's official cash rate, the OCR, whatever the short-term interest rate is, whatever the central bank is, wherever they place or set that short-term rate, that's going to influence your short end of the curve drastically because they will need to reflect whatever changes the central bank makes. So in that way, you will often hear us and market participants say that the Fed or the central bank controls the short end of the curve. But the only thing we mean by that is that by setting the short-term interest rate, they essentially control where the shorter dated yields will trade based on where they set that short-term interest rate. So whatever changes they make up or down will need to be reflected in, for example, the 1 month, the 3 month, the 6 month, the 1 year, the 2 year. That'll be drastically influenced by wherever they set that short-term rate. So in that sense, they control yields at the front end of the curve, but they don't really control it in the sense of yield curve control. It's just something we say, meaning that wherever they set the short-term rate, that's going to largely influence where those short-term yields will be trading at. Now, even though they control, in that sense, the shorter dated yields based on where they set policy, they don't actually have an influence on where the longer term yields are set, right? So if we take a look at that yield curve again, anything from 5 to 7 to 10 and upwards, they don't really have a lot of control on that. That is mainly set by market expectations based on three things. Firstly, expectations for what short-term interest rates will do in the future. So if you take a look at your 10 versus your twos right now, for example, you can see that your 10 is lower than your 2-year yield. And what the market is telling you here, the market-based 10-year yield telling you, is they think that interest rates will be lower in the future. And that, if you take a look at the Fed fund futures, that also shows you that the markets think the Fed will need to hike going into next year already. So that is what the difference between the front and the long end can show us, is that the Fed doesn't have control on where these longer dated yields are set. That is based on, firstly, expectations on what the actual short-term rates will be in the future. So i.e., do they think they're going to cut or hike in the future? Secondly, it's set by the market's medium-term expectations or outlook for the growth and the inflation path. Now, that again translates back into policy, right? If you think growth and inflation is going to do absolutely amazing in the future, you will expect higher short-term yields. And if you think growth has a lot of problems in the future, then you would expect lower growth and you would expect low. If you're expecting lower growth and inflation, you would expect lower yields. So the yields are based on, again, expectations of the short-term rate. Well, that'll be in the future, expectations of growth and inflation. And thirdly, long end yields also, the longer and the further you go out, there's also going to be various types of risk premia embedded in that yield. So obviously, the longer that you plan to hold onto a bond, you need to be compensated for various levels of risk, and there's obviously a lot of risk premia embedded into that, which might not mean anything with regards to what short-term interest rate is expected to be or what growth and inflation is expected to be. It might just be the risk premia affecting it. So both the short end and the long end is market based, but the Fed, based on where they set the short-term interest rate, has a lot of influence on where the shorter dated yields will be. But they don't have control over the long end. When they can influence the long end, though, if they wanted to target specific long end yields, for example, let's say the 5-year or the 7 or the 10, what they would then need to do is they need to use other unconventional policy tools like quantitative easing and quantitative tightening. So what they basically accomplish with quantitative easing is they push in a massive amount of massive amount of new money into the system. With that money, they start to buy bonds, let's say 5-year bonds and 10-year bonds. That pushes the price. It increases the demand for those products. It increases the price for those products, which pushes the yields down. So back in the global financial crisis, they cut rates down to zero, but it wasn't enough to stimulate the economy. It wasn't enough to bring longer-term borrowing costs lower. So keep in mind that things like your auto loan and your mortgage rate and your medium-term business loan and personal loan, all of those things are set using a benchmark, and that benchmark is usually your 10-year yield. So if your 10-year yield is high, it means that your borrowing costs associated to that benchmark will be high as well. So if they want to cut rates down to zero and they still need to stimulate the economy, they basically flush the system with liquidity, excess amounts of cash, buying up all of those bonds, the 5s, the 10s, the 7s, etc. That increases the price and it pushes down the yields. When the yields go down, it pushes down the borrowing cost, that medium-term borrowing costs. So they can influence it, but they don't control any of these yields themselves. But obviously, based on short-term and medium-term policy tools, they do have a lot of influence in where the market sets them. So to your question then as well, can some of the fluctuations also be explained by things like buying and selling from hedge funds and investors, etc.? Absolutely. Like any other instrument, because it's traded in the open market, it's traded in the secondary market, it'll obviously be influenced, like we said, based on if it's the short end, based on where the Fed funds rate is, if it's the long end, based on where growth and inflation will go, where policy will go, etc. Risk premium, all of that is still in place. But what can also just influence it in the very short term, the day to day, is plain and simple supply and demand, right? That can also influence where bond yields go. If there's like a massive block order coming into the market for whatever reason, a seller order, a buy order, that can obviously influence price quite substantially, and that can influence the yield as well. So there's definitely some of that in play, but the main drivers, like we explained for the short and the long end, is more market based. So hope that helps with the question there, Miles. Any others, don't hesitate to let us know.